Let's get more on this now with economist Cornelia Meyer. She's chairman and CEO at Meyer Resources. Welcome back to the program, Cornelia. Now, with Brent back above that $100 mark, what's the tipping point where these sustained high energy costs begin to force industrial shutdowns globally?
Good morning, Taib, and thank you very much for having me. Well, it's actually quite difficult to say, but it's not just the higher oil prices. It's also, you know, the petrochemicals, the aluminium, the helium, all of these things that need to come through the Strait of Hormuz and are part of the global supply chain. And at some stage, we will see scarcity of that. At this point, I think global production is still going, but they're also looking at where will the demand be. You know, if inflation is high, there will be less demand. So it's not that they're shutting in, but it's probably that they're going to produce less.
Now, beyond the immediate price hike, what are the long-term implications for global manufacturing if the Strait remains blocked for the remaining of this quarter?
Devastating, because as I said, it's the oil, it's the gas. It's for a lot of these very heavy industrial processes like steel, like glass, and so on. You need gas to power it. So this is really very bad, and it's all these other industrial inputs. But what worries me, frankly, even more is the fertilizer that can't go through. 30% of nitrogen-based fertilizer needs to come through the Strait of Hormuz. And those solid shipments have not gone through, and it's the planting season in the Northern Hemisphere. So we will only see in autumn just how badly yields are impacted, and the inflation in fertilizer also means that it becomes unaffordable for developing countries. So I am really worried about what, by the end of the year, the food security situation in places like Africa looks like.
Right. Meanwhile, we're seeing yuan-based payments gain traction in key energy routes like the Strait of Hormuz, challenging the dollar's dominance in oil trade. So is Washington's push to blockade the Strait purely about curbing Iranian exports, or could it also be about maintaining control over how global energy is priced and traded?
Well, I don't think so, because they have very little influence. And I think that has started to happen. It started to happen 6 to 10 years ago in a slow process that, you know, you would sell oil to China, for instance, in yuan based. And that has a lot to do with the dollar being the prime instrument for sanctions against Russia, sanctions against Iran, sanctions against everybody they have sanctions against. So this is a process that has been there for quite some time and is probably getting accelerated.
Now, we're also seeing a sharp jump in gas prices. How vulnerable is Europe in particular as it heads into this storage season?
It's extremely vulnerable because, you know, it's up. Yes, it's now up 18% right now. But if you look at from the beginning of the war to now, it's up much, much more. And that will be a huge inflationary pressure for Europe. It will be, as I said, for certain industries, it will be brutal. And what will be even more brutal is the competition that we will see between Europe and Asia for LNG. Because right now, the Qatari LNG went mainly to Asia. So Europe got the US cargoes and some other cargoes. But there will be so much competition for especially the US cargoes, that this will be quite brutal. And again, the people who will be left out here will be the Pakistans and the Bangladeshis of this world, who also need the LNG, but who get it usually from Qatar, through the Strait of Hormuz, but who will not be able to afford to be able to compete in such bidding wars.
And how do you expect central banks around the world to respond to these new waves of energy shocks?
I think, as your previous guest said, there is a big upward pressure for interest rates. You know, if inflation goes above the 2% target, then there is the upward pressure. U.S. is a bit different because they both have the 2% target and the full employment target. But in the short run, yes, there is a potential of even interest rate hikes. They certainly will not come down. But when I see if we are going into a full-blown recession, you know, in the style of we saw during the great financial crisis, we then may see quantitative easing. So yes, in the short run, I do see them going against inflation. But if we have a full-blown recession, the judgment is out.
Right, and we'll leave it there for now. Cornelia Meyer in Bern, thank you very much for your time.
Thank you very much indeed.